Then see the government grants relating to income. The accounting part is very simple, it is not as complicated as even the previous one. Let us look at the definition again. Grants related to income are government grants other than those related to assets. It is very simple definition, but for you to know what income related government grants are, you need to first know what asset related government grants are. Why? Any grants which is not asset related should be income related. So, it is like you being compensated to mitigate your expenses. Now, for an example, my very first or the second example rather, one of the previous, rubber industry was not performing well, and the government understood the problems and their grievances. So, the government is coming forward to support them. How? The required chemicals are made available at the cost of the government now. In this process, the government grants are to mitigate the expenses incurred by the entities in the rubber industry. So, that has to be income related government grants. And if the government is supporting for the garment factories in Sri Lanka to get their materials down at the cost of the government, so once again what is it? It is income related government grant. So, we have two accounting methods. What are these two accounting methods? Either it can be recognized into a separate item of other income, or it can be recognized and presented in the financial statements as a deduction from the related cost. So, as much as we have points in favor of deferred revenue rather capital approach and revenue approach under asset related government grants, people do have some points in favor of this and some points in favor of the other method to be recognized as other income. Now, if you see just one or two, if you show other income, now say we are in the rubber industry and the chemical materials, the chemicals 10 million rupees, and the government has given 10 million rupees as a grant, I mean to cover up the entire cost of chemicals, the government has given their subsidy. If this related cost of 10 million was negated against the grant to the subsidy, the material cost will be shown as 0. Then we are preventing some external users from being benefited from the use of our financial statements. Why? Because if someone wants to understand the contents or the breakdown of our cost elements, some of the cost elements are not visible from the financial statements. So, that is a drawback, that is a disadvantage. And we keep some information hidden somewhere, it is not visible, it is not apparent as a result of you netting off. But if you show the material cost as a separate item, and if you show the subsidy of the government as a separate item of other income, everything is transparent and it's detailed enough, and that will enable anyone to make any calculations, any decisions why everything has been disclosed and divulged. But then people who favor the other method where the related cost of 10 million can be negated against the grant of 10 million, what they say is far from recognizing the material cost, even the business wouldn't have been in existence unless the government gave this support. Why? If not for the materials, if not for the chemical, you cannot continue and proceed the production. If not for the productions, why the hell are we existing? And there is no reason why we should exist unless you can do the production. So it is the government grant which makes this company keep moving, and if not for this grant, even this cost wouldn't have arisen. If not for the grant of the government, even the cost wouldn't have arisen. So then you better net them off as required by LKAS 1. This cost can be netted off against the grant subsidy income. So the final balance can be presented to be 0. So those are some arguments. There can be some, but not that everything is that important for us from the examiner's viewpoint. You can apply either the first method where the grant is recognized into a separate other income item, or the grant can be recognized as a deduction from the related cost. The repayment of the grant. The grants we are receiving will have to be repaid back to the government for many reasons, such as for not being able to meet the conditions of the government. You know, before the grants are given, there are some conditions attached to it. Where the company fails to meet those conditions attached to the grant, maybe subsequently you become liable to pay it back to the government. And let us see how this accounting looks, what it looks like in case the entity who received the grant be liable to pay it back to the government. So let me explain with a small illustrations. The accounting for this depends on what method you have adopted to recognize the grant, especially asset related grant, whether it was a capital approach or whether it was revenue approach, under which whether it was deferred revenue method or cost reduction method. And if the grant is 10 million, if you recognize that into a reserve under capital approach, and subsequently if you were to pay this grant back to the government, simply it is just a matter of you crediting cash account and debiting to reserve account, and the reserve has to be derecognized. It is as simple as that. But there are some small nooks and corners to be looked into as you repay the government grant, and if you have adopted the revenue approach, under which we have two methods of recognizing that into deferred revenue and cost reductions. And let us see the accounting, and let me take a simple example. a simple question. An entity purchased an asset at 5 million rupees, the government granted 2 million rupees. The entity had to repay the grant at the beginning of the third year required to show the accounting. So, I have not specified the type of accounting they have adopted. Let me take both and to explain everything comprehensively. So, the capital approach is very simple. I need not to explain that again with another illustrations, and let me profusely explain the revenue approach using this particular example. If it is under deferred revenue method, asset balance by now at the beginning of the third year 5 million. And let us forget about depreciation figure, that is of no use here. Deferred revenue originally, having received 2 million rupees, we would have debited cash and credited to deferred revenue account by 2 million, and I have not given you the lifetime and the depreciation method. So, the lifetime is 5 years, lifetime and straight line depreciation method. Straight line depreciation method, fine. Now, you know, under deferred revenue method, the balance in the deferred revenue account need to be released to profit and loss gradually in bits and pieces over the lifetime of the asset using a method which is consistent to depreciation method. So, that was straight line method over 5 years. Of this 2 million, how much would have been transferred to profit and loss annually? 400,000. So, how many 400,000 would have been transferred? 2. 800,000 would have been transferred in the previous 2 years already, and what is remaining by now is the remaining amount of 1.2 million rupees, 1.2, made a mistake, it is 2 million rupees, balance, remaining balance is 1.2, here the balance is 1.2. Now, for failing to comply with the conditions attached to the grant of the government, we are now under the obligations to repay it back. Now, deferred revenue no longer appears in the balance sheet or in the financial statements if you pay it back. So, what is the amount to be paid back to the government? You need to pay the full amount. It depends on the details of the questions. I have not specifically given what amount to be repaid. If the examiner is silent on that, we can reasonably assume that we have to pay the full amount of the grant. So, what is the amount to be paid? 2 million rupees, and how should be the accounting? You need to credit to cash account by 2 million, and with the repayment of the grant, no longer can we show deferred revenue in the financial statements. You credit cash and debit 1.2 million rupees to deferred revenue, but your total paid amount is 2 million. Out of 2 million, you debited 1.2 million to deferred revenue. Where do we debit the balance 800,000 rupees to? The balance 800,000 should be debited to profit and loss. So, the amount of 800,000 rupees of deferred revenue recognized to profit and loss over the last 2 years will be withdrawn back from the profit and loss at once instantaneously. So, 800,000 rupees that got credited to profit and loss over 2 years time, over the last 2 years, will get pulled out from the profit and loss at once as you repay the grant. So, that is what has happened now. You credited profit and loss by 800,000 rupees over the past 2 years, last 2 years. That 800,000 gets pulled out from the profit and loss at once at the beginning of the third year as you repay the grant. So, that is what is happening. So, it is as if we haven't got anything from the government. It is as if we having paid and financed for the purchase of the asset by ourselves. Now, what do we do as we repay the grant? If you adopted deferred revenue method, the balance of deferred revenue should be made 0 by debiting the repayment to the deferred revenue account to the extent of the available balance, and the remaining 800,000 should be debited to profit and loss to nullify the effect of the grant credited to profit and loss over the previous years. Now, let us see how the accounting should be if you adopted cost reduction method. Cost reduction method. Let me reopen up the asset account. Cumulative depreciation. And the grant would have been taken elsewhere to a separate account, grant, and this is shown as a deduction from the asset. Asset value, balance is 5 million, grant is 2 million. As you present it in the statement of financial position, the asset value has to be 3 million, which is a different story. Why is it important? Because as you start depreciating the asset, it is not based on the original cost of 5 million rupees, that would have been on 3 million rupees. So, 2 years have gone, the balance of depreciation figure now should be how much? The balance would have been 1.2 million rupees. So, let me bring cumulative depreciation balance here 1.2 million, right. At the beginning of the third year, the entity is required to repay the grant, and this account can no longer exist in our accounts now. So, you can credit cash and debit to this account so that the asset will be reshown. Now, that will make our depreciation figure inaccurate. Why? Depreciation figure by now has been based on the net cost of 3 million rupees. Since you paid your grant back, your cost of the asset or the value of the asset got restated at its original cost of 5 million rupees. So, you also have to restate your depreciation accordingly. How much? What if you paid 5 million rupees to buy the asset at the beginning, and if you started depreciating it at 20%, over 2 years time, what would have been the cumulative depreciation figure by now would have been 2 million rupees. So, we are short here by 800,000. Credit to cumulative depreciation account and debit where? You should debit to profit and loss. Debit to profit and loss, right. In either method, deferred revenue and cost reduction method, how much of the repayment is debited to profit and loss? 800,000. So, your method can be different, but the final impact on the financial statements cannot be different based on the method. So, the final impact to the profit and loss has to be 800,000 under either method. So, this is how the repayment is accounted. Just one small point to be explained before we wound up and put our curtains down for the discussions. Let us see what it is. I could not explain the recognition criteria of LKAS 20. Let me explain that part and then finish and wind up our discussions of LKAS 20. Recognition criteria. You know, every accounting standard is structured in a sequential order. So, what do we discuss in the context of accounting standard? You discuss the scope and you discuss the objectives, you discuss the definitions, you discuss the recognition criteria, and you discuss the initial measurements, subsequent measurements and the disclosures. Let me explain the disclosure requirements of government, not the disclosures, I made a mistake, recognition criteria of government grants. What do you mean by recognizing? Recognizing is where you bring government grants into the financial statements. Before you decide to bring the government grants into the financial statements, you need to look at two factors, and I want you to look at the standard. Recognition criteria, government grants including non-monetary grants at fair value shall not be recognized until there is reasonable assurance that the entity will comply with the conditions attaching to them and the grants will be received. Now, as we studied repetitively, there are conditions attached to a grant, conditions attached. And you must have a reasonable assurance. The level of reasonableness has not been specified in the standard, that is up to you all to judge. The level of reasonableness has to be assessed in the business organization, that is not stipulated in the standard. There has to be a reasonable assurance that the entity will be able to comply with the conditions of the government. Now, let me take the very first example I took. The government decided us to give that land value of 500 million rupees on the condition of being able to create 1000 job opportunities. And we are pretty sure, as clear as crystal, that the government will never break the promises. Let us forget about the Sri Lankan government existing now, we will think of another country's government which never breaks the promises. And the entity has a strong and a solid assurance that the government will never break the promises, we will get it, but what is the issue? We are not pretty sure whether we will be able to create 1000 job opportunities. Then, until you get that assurance of being able to create 1000 job opportunities, you are not recognizing the grant into the financial statements. You cannot debit to asset account and credit wherever it has to be credited to. Why? We are not having that required level of assurance of being able to comply with the conditions of the government. And if the government gave us 1000 Juki machines on the requirement, on the conditions of getting all our materials down only from the local suppliers, not from the foreign suppliers, and we know we can get the fabrics from Sri Lankan suppliers, we can get the thread from the Sri Lankan suppliers, we can get the buttons from the Sri Lankan suppliers, but there is no any company, any manufacturer who manufactures zippers, we have to get it from YKK, Japan. So, we are pretty sure that some of the materials required for the production should be from a foreign supplier. What is the requirement and the condition of the government? Nobody can get any material from anyone outside the country. All the material should be from the local suppliers. Since we are not having that required level of assurance of complying with the conditions of the government, you cannot recognize the grant, you cannot bring it to the financial statements. Second one, the assurance of receiving the grant. Assurance of receiving the grant. Now, we are opening up a factory, garment factory, with 1000 machines, massive operations, and we have lot of customers, foreign customers all over the world, and our distinguished chief guest has been or the president or the prime minister or a cabinet minister, and in his speech, just to please everyone of the audience of the gathering, he makes a public statement explicitly saying that the government decided to grant another 10,000 Juki machines to this company in order to support this entity to expand their operations and to generate more and more foreign income, and everyone gave this speech a standing ovations. Everyone was happy, everyone was pleased, thinking that we will get this machine just in 2-3 years or 2-3 weeks, 2-3 months time. But this is from a local politicians, one of the most corrupted, and he is like the icon of the corrupted politics in the world, and this is just like another set of empty words shot out from the most corrupted politicians in the world, and you cannot rely on his statement. Then just because he makes that in a statement, it does not give us the required assurance of being able to receive that grant from the government. And it does not mean that you can open up the books of accounts and to debit to a receivable account and to credit to deferred revenue, or wherever it should be credited to. Why? That statement does not give us the reasonable assurance that we will be receiving the grant, but just in 2-3 weeks time, which much surprise and delight to almost everyone in the company, we got a letter from the Prime Minister office or the President office saying that they are going to give us 10,000 Juki machines on such and such date at such and such time. Please make yourself available at the meeting to receive the machines, and then we have that reasonable assurance of being able to receive the grant. Now only you can recognize. So, you need to look at two criteria. What are the two? Make sure the entity can comply with the conditions of the government. Second is what? Make sure the grant will be received by the government, and then only you can do the accounting for the government grants. Then, as I said at the beginning, for the government assistance, the accounting will not be required. Instead, we can do some disclosures. Why aren't the accounting for the government assistance required? Not that it is not required, you can't do the accounting for the government grant, I made a mistake, for the government assistance. Why? Say we are in the tourism industry, Sri Lanka. And this is like a sinking ship, and we have been experiencing and suffering a lot of grievances over the last 2 years, and we are right up to the neck, and it's just a matter of drowning and committing suicide now, and it's dying almost. Now the government is coming forward to stretch their helping hand and to resurrect this industry once again, to reform it, to revive and to revamp this business industry once again. The government says the biggest issue is that nobody in the world knows about our tourism industry in Sri Lanka. So we as the government is going to spearhead in propagating your industry all over the world so that you all can save your money, and we will let us bring the customers to you all, and you can serve to the customers, and it's going to be such a huge saving of cost to all the enterprises in the country. So the government has budgeted to spend $10 million only for the propagation of the local industry in the world. We are in company A. We will also be benefited from this assistance. But can you exactly measure the amount of cost incurred by the government in particular on our business out of $10 million? Are you in a position to measure the amount of cost the government has incurred on our business propagations in particular? We are not in a position. Out of 10 million rupees, the government would have allocated how much to our business? Is it just $1,000 or $10,000 or $5,000 or no cost? What is it? How much? You can't measure. If you can't measure that in terms of local currency, you cannot do the accounting for that. Not that we should not do any accounting for the government assistance, just that we cannot do the accounting because the amount of cost incurred cannot be measured reliably, and that is why we do not do the accounting. You will do the required disclosures. So, that is the end of our discussions of LKAS 20, an important standard. It is simple though, and I am pretty sure you got everything from the standard, and once again we appreciate of you being our student and watching our videos, and thank you for watching our videos of webinars.